welcome everybody, and I appreciate you taking your Wednesday night. We're going to talk about exiting IRAs and 401ks and asset protection that some of that affords you. And we're going to talk about the stretch IRA that's no longer here and why I think some of these strategies will help people in the future. So let me just get this disclaimer out of the way. Camera Plan doesn't provide investment advice or endorsements. All the information here for educational purposes, and we encourage all the parties to consult with their specialties, attorneys, accountants, financial advisors, etc., before investing into any type of assets, and do your due diligence on us as well in any investment that you're going into. Tonight, we're going to just touch on Camera Plan background because we've been running this series. This is the fourth session this summer. We're going to talk about self-direction, some of the asset classes. Quickly, we're going to talk about the stretch IRA rule change and why these strategies make sense now, right? So when we talk about the exit strategies, people always say, well, when and should you do it? And why should you do it then? That answer varies with all kinds of people and what their personal circumstances are. Some people might have a sick spouse. Some people may lose their jobs. So there's a lot of different reasons for it. We'll talk about taking the money after you're 59 and a half. And then we're going to show you some cool ways to take your money without penalties before 59 and a half. Everybody always says, well, I can take it before 59 and a half if I die. And yeah, that's true, but that's my least favorite way to take the money out of an IRA or 401k. And we're going to touch on asset protection and the different strategies associated with that, estate taxes, because you want your IRAs, etc., not to be paying estate taxes or income taxes on them before or after you die. But I think that'll be pretty cool. Who's Carl Fisher? I grew up in Lauderdale. I launched rockets at Kennedy Space Center. My family's done a lot of real estate investing. I still own real estate property today. I'm a buy and hold guy. I was married in 1981, and I have 4 boys and 8, almost soon to be 9 grandkids. So I'm very, very blessed, and I'm happy about that. Camera Plan was founded in 2004, so this is our 20-year anniversary. Our headquarters is Ambler, Pennsylvania. We have thousands of clients across the country and some in foreign lands. We have a reputation and a commitment to excellent service, and most people that come from any of our competitors tell us that and find that to be the case. We work with a lot of fund managers and syndicators and other money raisers and businesses to get more capital out of their existing clients. So we'll help those people do that. And obviously, the reason that their existing clients like to do that is because they boost their return because they're not paying taxes on that money. And it's a good deal for both fund managers and the clients because there's more money to invest or reinvest, and there's more interest or earnings to be made. We educate our current and prospective clients on investing with IRAs and 401ks, and people can go onto our website, camaplan.com. These classes a lot of them are recorded. You can show up to our office almost every Wednesday, and Will Mucker, who's on here with me, runs an IRA 101 class. So think about that in the future. Quickly, what's a self-directed account? Or account owner directs all the investments. Basically, it lives by all the rules of other IRAs, but you have more asset classes to invest in. You get to invest in almost anything you want except life insurance and collectibles. And what we like the most is that you get to invest in what you know and trust and understand, which always makes investing safer and more lucrative. So tonight I'm going to go over these stages of life relatively quickly, because all of these things make a difference as to when you want to take that money out and when you want to put it in. In the first area here, if you're talking about a teenager or a child or a college kid, right? Most of the time, no sense, no money, no savings. They got a lot of time and they got a lot of energy. Some of them do work, some don't. More, I think, don't today than did when I was a kid. And then they graduate college, they move to an apartment, they get a job, maybe they're paying some school debt, they're making minimum income because they don't have any real experience. You go a little bit further down the timeline, they get a house, they may have kids, their job has a 401k, they look at IRAs, health savings account, educational savings accounts for their kids because they're worried about their health and education and retirement. So they start paying some attention to that. Their income has increased a little bit, and maybe they've got savings or maybe they don't. But it's a good time to look at that. And while you're in these stages of life, you want to look at your income, what your tax rate is, you know, how old you are, what's your return on investment, and then you might want to be thinking about Roth IRAs and conversions, because I'm biased towards Roth. But after you raise your kids and you push them out of the nest, you become empty nesters. You can generally have savings. The house is paid down. You don't have as much deductions as you used to have. You're still in your 401k, and you're usually making significant income. And then obviously you move further out, you're retired, you're on Social Security or Medicare, and maybe not retired. You have savings, your house is now paid off, and you're using Social Security for part of your income. You may have a pension or a savings account or your IRA, 401k, health savings accounts. You're using those for spending money. So your income may or may not change at these different phases. Your tax rate obviously will change based on what deductions you have, etc. So what I'm going to talk about today, take notes, and what applies to you, write them down and use them for your own plan. Some things will and some won't because of, you know, your age, where you are economically, where you are in the game of life. Are you in the, you know, the last half or the, you know, the first quarter? So if you're under 59 and a half years old, you can get money out for being a qualified higher education. You can do it for first-time home buyer. And by the way, these numbers change over the years. It's some of your IRA, not all of it. If you have a disability, they'll give you an exemption for that. Medical expenses, that's 7.5% of your AGI. You can use your IRA to help pay that. You can even make deductions from your IRA to your health savings, or you can make a contribution from your IRA to your health savings account as well. Health insurance premiums, if you're unemployed, you can use your IRA. And then one of my favorites, if none of those are helpful, who wants to be disabled, who wants to be sick, I like the substantial equal periodic payments. It's like an annuity. You know, you can 5 years. You have to, once you start it, you have to run it for 5 years. You can start it at basically any age. But and there's 3 ways to figure it out, and I'll show you a chart like that in a minute. I'm not going to go over the 3 different ways to use a substantial equal periodic payment. But if you're interested in that, call the office and we'll help you, or talk to your accountant. And it depends on how much you want to take out and how fast, and you're allowed to change it too if you want down the road. Reservists that are called to active duty can use it. Court-ordered withdrawals such as divorce and property settlement associated with it. The IRS can levy a lien on it and take it. I haven't seen any of those yet, but they have. They're different than most creditors in that they're allowed to do that. And as I said earlier, my least favorite is death. When you die, the money can be withdrawn. This is a 72T, like an annuity. This presentation is recorded. It will be available again. And if you want any of these details, you can look it up, or you can call our office. We'll send you a copy of these slides. Just talk to Will tomorrow if you want to learn more about these details, because it's a little bit boring, but you go through the numbers and it tells you how much you can take out based on your age, life expectancy, and the amount of money in your account. This is more of the same. This is a fixed annuitization method. So it talks about the different methods that are there and available to you. And I would run it in all 3 methods, just so that you can see which one would be more advantageous for you to start taking money out of. And this information comes from treasury.gov. All right, so this is one of the things that when you're talking about exiting these IRAs, you want to not cut yourself short, right? It's not helping your heirs. And I used to say, it's great to pay for your kids' education, but what you don't want to do is you don't want to sacrifice your retirement for your kids' education necessarily. Some people disagree, but the problem is if you live a long time and you don't have your own money, you run out of money before you die, then that falls onto your kids. And that's very real in today's 60 to 70-year-olds, or 60-year-olds are taking care of their parents in a lot of situations. And it's not cheap, somewhere between 15 and 20,000 a month in a lot of cases. So understand your situation, know the circumstances that you're in, and there's not one answer for that. As an example, there's, in my family, there's 4 kids. Some are doing better than others. Other families I talk to, I see the same thing. Some people could use a little help. Some people are looking for tax write-offs and tax strategies to incorporate. And you want to look at their capabilities and where they're going in the future. And we'll talk a little bit more about that. And that's assuming that you have money left over from taking care of yourself. Is someone qualified to manage your portfolio? Think about that. Suppose you build this portfolio and you get it there, which I've seen, and I call it the engine of the train. Everything they're doing, they're pulling everyone along with them. But if that engine breaks down, is there someone ready to step up and help manage your portfolio? So think about that. Think about bringing people in, especially if you have self-directed IRAs. They're not as easily understood as a stock or a bond that can be sold pretty much at any time, especially if you've got real estate or notes or private placements in them. We're going to talk about the IRS statute changes, right? One of the things Trump did was he got rid of the stretch IRA, which I had pretty much organized my whole estate plan around. And I was putting everything into Roth IRAs, and I was setting it up so that it could go a century and go down several generations. What happened was they killed that stretch IRA and they said, no, we let you use this money. There's no reason for your grandkids and great grandkids to have access to it, because that's too many years that this money is out of circulation, not making payments to the government in way of taxes. So what they've done is they said, once somebody dies, you get to use that IRA if it's a Roth or a traditional. You get to use it for 10 years. You do have to take contributions out of it every year. But by the time after 10 years, you have to basically take what's ever left and put it back into the taxable economy here in America. Catch-up contributions for high net worth individuals have to be Roths, and that started in 2024. So if you make over $400,000 and you want to make a catch-up contribution, it's going to have to go into a Roth portion. Now they've made SEPs, simples, traditional IRAs, all of those, you'll have to open up a Roth component to make those catch-up contributions. And people said, well, that's for the people with making over 400,000. That doesn't really apply to me. But when income tax was proposed in the United States, it was only on people, I forget the number, but let's say 400,000. People that made over 400,000 were the only ones that had to pay income tax. And now we've seen where that's gone. In the past 100 years, everybody's paying it. So I don't know if everybody's going to end up paying this, but they did enact it in 2024. And I talked about taking care of parents in nursing homes or private facilities. There's a good chance you can pay anywhere from 15 to 25,000 a month, depending on what state you're in and what the health of your loved one is. So where are you right now financially? Are you barely making it? Do you need Social Security and your 401k and your IRA to live on? Is your investment income coming in? Or you working until you can't? Is that your philosophy? Are you bagging groceries for a little extra? Do you have a side hustle? Think about that. And then the wealthy people, they're worrying about estate taxes, and how are those going to get paid, etc. Or are you somewhere in between? Right, that's what you have to think about. Today the estate taxes are 13.5 million per person, or 27 million per couple. That's supposedly going down next year if the Trump tax cuts expire. But write that down, understand where you fall and how you want to make that to it, right? Don't be a burden to your heirs. Let them inherit it if there's anything left. Take care of yourself. Teach merits of investment decisions to your heirs, and take cash now for the younger crowd. If you want to do that, if you know that you have enough and you want to help help the youngsters out, we'll show you ways to do that. Withdrawals now and 17,000 gift tax for medical maybe, or educational payments. As an example, if you take a Roth IRA and you take a $17,000, even say $34,000 distribution, you're not going to pay taxes on it because it's from a Roth, and then you can make that a tax deductible or a tax-free gift to your children. Maybe they want a house, they're going to be buying a house to live in. Maybe they need it for education. Maybe it's for medical expenses or an operation. Maybe it's for them to get married, etc. But there's a annual gift tax that can be done. For 2024, it's $18,000. 2023, it was $17,000. And then there's charitable distributions if you want to give to any of your favorite charities out there, right? So think about these questions. I would write them down. I'd look at them yearly. I don't believe in set it and forget it. Touch this, probably in November every year with your accountant or your financial advisor, because they're finished with the taxes for the year and they're getting ready for the next year taxes in January. So most accountants are available to you after October 15th and before Christmas. Considerations when exiting, using, I think that's supposed to say dollars. So review your goals and assess your financial situation. Look at yourself and your heirs. Have to understand IRA distribution rules and plans and RMDs. As an example, Roth IRAs, while you're alive, have no RMDs. Does it make sense for you to convert your traditional money to a Roth so that you don't have to take RMDs? And the other thing with the money coming out of traditional IRAs is always taxed unless there's non-taxable contributions there. And there's ordering rules for both of those. As an example, for a Roth IRA, they say the first distributions is the contributions you've made to your Roth IRA. After that, it's the earnings in your IRA. And then there's also rollovers considered in there as well. So understand the distribution rules. If you don't, talk to your accountant, because how you pull that money out can make a big difference on how long it lasts. And one of the things I'm going to touch on later on is, let's say you have $500,000 in your traditional IRA and $500,000 in your Roth IRA. The Roth IRA is actually more valuable to you because there are no taxes coming out of it when you pull it out. Out of the traditional IRA, you're going to be taxed at your normal rate for the year you take those distributions out. And bankers, et cetera, and people figuring out your net worth never take that into consideration. So write that note down. I'm going to cover it a little bit further down again so that you can see what happens if you don't do that, right? Review portfolio, right? Simple or complex, who's in charge of it, taxable or non-taxable, for whom and when. And what I'm talking about there is, do you want to tax it at the maximum tax rate yourself at 37%? Or do you want one of your children that's in a low tax bracket to pay the tax on it at their lower percentage? Or vice versa, if your kids are at a high tax bracket and you're at a low one because you're retired and you're not bringing in any more income, it might be worthwhile for you as the parent to pay the taxes on that money and make the conversion. So just kind of understand that when you're working with the family and your legacy going forward. Designated beneficiaries and inherited IRAs. You can obviously do those. There's spouse and non-spouse considerations. As an example, if a spouse dies, the remaining spouse can take that money and make it part of their IRA, and it is an inherited IRA, so they can keep that IRA for the rest of their life. If it's a non-spouse, then they have the 10-year rule on that. So these rules and regulations, put somebody on your team that can help you, that thinks about this for it, right? And then strategic distribution, know your estate planning, give it out before the estate has to pay taxes on it. And also, I'm talking about federal taxes, but states have different estate tax rules and limitations. Charitable giving, they're still out there. People can still do it. So stay informed with rule changes for IRAs. We generally will go over them in our office every year. So let's talk about IRAs and how many and what the strategies are associated with it. In this case, there's 3 Roth IRAs. The first IRA has a building in it, and it's separated because that building has liability, and it's separated from the second and third IRA. The second IRA has another building in it, and each building, I personally put into a separate IRA. Now, in my third IRA, I'll put a note, I'll put gold, I'll put a mortgage, etc. in there because they don't have any real liability associated with them. And let's say between those 3 IRAs, I have $400,000, and I split them up between the 2 kids. They get 50-50% on there. I also have in the bottom right-hand corner, I have a little bubble that says trouble, and that's for if a note gets in trouble or a mortgage and I have to foreclose and it's going to turn into a property, I'll transfer that note or that property into that, 4th IRA at that point in time. And the 2 kids are going to get 50%. And if it was 4 kids, it'd be 25% of all the money in these IRAs when I pass. And just keep that on there, but this is set up basically for liability reasons. Here's another one, right? So how many accounts and why? Tax-free money now. So let's say I have 400,000 in my IRA, all told, but in the Roth 1 IRA, I give to my son, and in the Roth 2 IRA, I give to my daughter. And these are babies, but let's talk about now if they're in their 30s or 40s, and if they want to buy a house. I can take that money out because I'm over 60 years old, and I can take that money out and I can gift each of them $18,000, right? And my wife can gift each of them $18,000, and we're not going to pay any taxes on it. So I'm going to be able to watch my kids take this money, spend it on their grandkids, and also build their own IRAs while they're doing it, right? They'll be able to build their IRAs to help their kids out because I think I have more money than I'm going to need in the future. My family, my dad died at 60, my mom's 92, so I'm going to take the average of that. Wish I was a little bit more on my mom's side, but not, the men don't live very long in our line of DNA and genes. So instead of having, in the last example I showed you where everything gets split 50-50, I'm splitting it ahead of time because, as an example, my son might want $50,000 out of his Roth IRA, and my daughter doesn't need any money. So he may take 50,000, ask me to get 50,000 out of his Roth IRA. And I do that, and his Roth IRA would go down in value. But meanwhile, my daughter's IRA would go up or stay the same. So you can kind of see I think it's a little bit more fair. If they need the money now, it's available to them and they can have a better life. So this is where we're going into it when I'm talking about the beneficiaries. Still have the same situation, but what I want now my kids to do with my Roth IRAs is I want them to help me grow it. If they help me grow it now, one, I have more time to spend on things I like, and two, I can take that money out if they sell a property or get interest from a note. It doesn't matter. I can now take that money out and transfer it to them and keep their piles the same, right? Again, if the daughter doesn't need it, then great. If my son does need some money, I've now given it to him and his IRA is down a little bit, but maybe he's helping me grow that IRA and I can give him the money as a result of it with the tax-free annual gifts between my wife and his kids and his, their wives, etc. I can give 18,000 to 6 people and my son's family every year, tax-free. So this is something that I've implemented because I'm going to have Roth 1 and A, A and B, because they might have liability or issues without liability and issues or properties that do have liability or assets that don't have liabilities. So we would put it in there. And maybe Roth 1B is a savings account. He doesn't want to keep it in a savings account. He keeps it in the Roth, and now it's asset protected from the majority of lien holders out there. And then obviously I have another generation, and I can move these assets around because they're all my IRAs, but I'm now soliciting help from my kids to either find a deal or help me work on a deal. I hope that makes sense to you. And if more kids come out or things come in, we can go to the next generation down in that help in the lineal descendants. Here's kind of right the 18,000 per year, 2024, each kid, each grandkid. So as myself, I put myself in the parent and spouse position, 3 kids here, and then I give 18,000 to each one of these people. My wife can give 18,000 to each one of those people. So you can kind of see how that money can grow if they're there and they're able to, help you. And quite frankly, I enjoy working with my children and teaching them these things and letting them see them. A lot of them do them already themselves, and they're building their IRAs. But if they can get the money now in their 40s, why not? Right? And still build their total net worth. And some of the grandkids that are, now teenagers are starting to touch on it. So I just think this is a good strategy to put in place. The end of the 100-year stretch IRA. You start these kids building their IRAs now, you integrate them with your kids, and you're helping your kids if you can do that. So looking at this thing here, parent and spouse, I can also put my mother, who I said was 92, up there and pay her and have her make contributions and her do earnings. And if she could get her IRAs up to that level with my help, then that would obviously come back down to me, especially if it was an IRA that I was the only beneficiary to. Instead of having, in the previous examples, all of these IRAs split 50-50, I've now put a beneficiary on each one of these IRAs so that they know where they are and how much they're going to inherit at some point in the future. So think about this from your grandmother, if you're in, or your mother, if you're in your 40s. Is your mom and dad still alive? Is their mom and dad still alive? Because you can put them in the payroll. Your mother-in-law, right? And after you get their accounts 5 years seasoned, then you're good to go on any of the earnings that those things bring in. And maybe you even want to do a 72T, substantially equal periodic payment, to bring money in without any penalties if you're before that age. So there's a lot of ways you can get money out before you're 59 and a half. You might need some family participation, or what we used to call as financial friends at different ages, to help you do this. But obviously I like to see the tax-free income going to the people after you spent that time. And I was going to, push that out, like I said, for a century, but I'm actually enjoying seeing what the kids are doing with their money and working with them on different projects. So ideas and taxes, kind of to summarize where we are, right? One, if you are giving out the gift tax, you're drawing down on your estate tax. Most people don't have to worry about that. It's presently over 13.5 million per person, or 27 million per couple. But state estate tax may have a lower limit than the 13.5. The scholars and the IRS has been talking about changing this, and I've heard numbers anywhere between $3 and $7 million per person, which would drop this down considerably, in half per se. This is another thing that a lot of people don't understand. Estate tax and your net worth. Right, this is what I was talking about a little earlier in the presentation. A traditional account worth $1 million versus a Roth account worth $1 million. If you pulled all that money out, you would be paying, let's say, $370,000 on the traditional account, and on the Roth account, you'd be pulling out $1 million. So it's significantly different. 37% different at the highest tax bracket today. But when you give your statements to a loan officer at the bank, right, or accreditation companies, they count the traditional account and the Roth account as equal. Right? Are they equal in tax and cash flow? Not at all. But just so you understand, that's what happens there. So to me, someone with a Roth account is wealthier than someone with a traditional account. Yeah, I'm sure there's circumstances where it's more or less based on their tax brackets, etc. So I just want people to understand that aspect of it. Gold, precious metals, cash isn't tracked by the government. And I've seen people push that cash and gold as part of the gift tax, up to $18,000. And I'd like people to take these rules, make them part of your legacy, teach them to your heirs, because they're the ones that are going to benefit the most from it, unless you want to teach it to your parents, and then you're going to benefit a lot from it if they look at these ideas and and put them into context with what your tax planning, estate planning, and cash flow planning has for you. All right. This chart I showed in one of the other presentations. Basically, the dark green's no income tax. The light green is exempts all retirement income, and the light blue it exempts some retirement income. So look at where you think you're going to live and put that into your estate planning. The dark green, obviously, there's not going to be income tax on it. But if you're going to go to any of the blue states, especially if you're going from a green or a light green, you may want to check out what's exempt retirement income and what isn't. People don't think about that and they get taxed more. I think we've seen this chart here. If you want to open up more accounts, it's $25 to open that up, to give yourself, as you saw, we're talking about the liability separation with the different IRAs. Some attorneys even say that separate IRA with a separate LLC. If they do that, that's great. I'm not going to tell you not to do it, but how much protection do you want? It's pretty easy to open up a separate IRA for $25 without any real extra reporting or tax capabilities with it. We have no annual fees unless you have an asset other than cash. So if you have a savings account, please consider turning it into a Roth so that you have the free asset protection. So if you do get a lawsuit or attorneys looking at you for payments, they don't see a savings account. They only see a Roth IRA, which in most cases they shouldn't have any access to. All right. And again, we've given you a lot of information over these last 4 weeks. We're going to have a Q&A session, but I want you to understand that we have free consultation with myself as a National RIA member. Call the office and we'll set that up. And obviously you can do your personal, not air it over chat here or over the webinar, but feel free to call in and set up with one of our account executives. So that's kind of where it is. You can scan this QR code to open up your account, I believe, or get more information, and hopefully that works for you. Any problems, call Will in the office. So at this point, do we have any questions in the chat? Will?
Yes, sir. Great presentation. We do have some questions coming in now. Tim asks, if an employer doesn't require me to quit my job prior to starting to use an SDIRA with them, does Camaplan help set up as a SDIRA in this case?
Yeah, of course, we'll always help you set up an SDIRA. And I'm assuming that you can always set one up, all right, whether you have a 401k or not. It just depends whether or not it's going to be tax deductible, et cetera. But we'll go through those specific questions with you and definitely get you an account open. If you're talking about if you have a 401k and you've got a way to get some of that money out and roll it over to an SD IRA, yes, we'll help you set that up as well. And if you've got a 401k and your boss or your company will allow you to also self-direct that, which we have several companies that do that, will help your company as well as yourself set that up.
Thanks for the answer. We have some more questions coming in. We also have Tim thanking you, saying he's enjoyed these 4 episodes you've done and he really wants you to come back.
Well, that's good because I'm going to come back next month and we're going to have Q&As for any of these sessions. And I'd like for you guys to email engage@Camaplan, or you can get a hold of Lori at National RIA and send your questions in and we'll make sure they get answered. Or you can come on the cuff and give us questions.
Absolutely perfect. That was Tim who said that. And then Jim is also thanking you for the presentation. Catherine has a question. She says, can I move 18,000 from my Roth IRA to someone else's Roth? And if so, do they have to be family?
The answer is not directly, you can't. I mean, we do that if a couple's getting divorced, we'll move money from one Roth, from one of their Roths to the other. But no, you can't move 18,000 from your Roth to your kid's Roth. You can take 18,000 out of your Roth and then give them 18,000 that they can go spend, or they can go put in to go put in 6,000 or 7,000 into their Roth IRA from that 18,000. So I hope I didn't confuse everybody there.
Perfect. Thank you. Another question from Wendy. Is there a way a child can inherit a parent's self-directed IRA?
Absolutely. The parent has to die generally, though. And then the child is the primary beneficiary of the IRA, and they're going to be able to use it for 10 years before they have to take it out. Or they're only going to be able to use it for 10 years before they take it out.
Thank you for the question, Wendy. Thanks for the answer, Carl. Another question coming in from Jeffrey. Jeffrey says, what if I have most IRA assets in a regular IRA or a traditional IRA and not a Roth? How can I avoid taxes as much as possible?
All right, I'm gonna, and this is a great book. It's called Keep It, KEEPIT, and it's by Joe Luby, LUBY, and it talks about several strategies to convert traditionals to Roths. And the other thing you can do is you can do it over time. We had one client that started doing it, and I think she did it in 10 to 15 years, converting a little bit every year so you don't get the big tax burden.
Great. Another great question. Thank you, Jeffrey. Thanks, Carl. Another question comes in from Pamela. She wants to know, you only mentioned Roth IRAs being protected from lawsuits. Is an IRA also protected?
Traditional IRAs, health savings accounts, educational savings accounts, 401ks, all have certain protections to them. 401ks, a lot of people say, have the most protection, but almost all of those, traditional, Roth, etc., all have creditor protection. And the reason is the government doesn't want people taking people's retirement accounts, because then it's going to fall on them to pay for them in their retirement. And the government doesn't want to do that.
Thank you. Thank you, Pamela. Thank you, Carl. Tim wants us to give a hello to Joe in the office. I'll do that personally tomorrow morning. I appreciate his help in me buying my first mortgage note. This note coincidentally was paid off today, and I'm looking to buy note number 2 this week. Congratulations, Tim. Another question comes in from Donna. Do conversions still make sense in your mid-60s?
Yes, the answer, it's simple. Conversions make sense whenever you're in there. If you remember the chart where I was talking about the stages of life, where's the best time to do it? Let's say you're retired and you're on Social Security income and you came from a 250 or $300,000 a year job. Now might be the exact time to go do that, because if you had done it earlier, you would have been in a higher tax bracket. Figure out how much you feel like converting, see how much tax you want to pay for it, and then just convert. Let's say I only, the most I want to pay in taxes is 20%. Talk to your accountant and say, hey, how much of my IRA can I convert and still be under 20% in taxes? And they'll give you that answer, right? I mean, I would say we could help you figure that out too, but then you're gonna have to tell us everything about your, how much you make, et cetera. Your accountant already knows it, and it's a simple question to him. How much can I convert this year and stay under $20,000? There was people that converted and paid almost zero tax, a lot of realtors back in 2008 and 9 when they weren't making any money. Right, so they converted, I don't know, 15,000 without paying any taxes.
Thank you for that question. Just because this question is easy to answer for Tim. The book Carl mentioned was called Keep It, Keepit, by Joe Luby, Luby.
Yeah, if you can put that in the chat, that would be great.
Yep. And then
I think it's on Amazon, and I think it's $20. And if you can save 20,000, what kind of a return is that? If you can save more than that, or 20,000 each year for the rest of your life, how good is that?
Absolutely. Looks like Tim found it. Steven says that those assets are not protected from IRS collections. I'm assuming he's referring to IRA assets.
Yes, I mean, that's what I said. There is in that one, I said the IRS are the people that can take it. That was one of the reasons your money comes out before you're 59 and a half. The IRS can basically take any money you have. And also you have to realize that the IRS, the burden of proof is not on them, it's on you. You're guilty until proven innocent in the eyes of the IRS. So yes, you're 100% right. Hopefully I said that right in the presentation when I talked about the IRS levy. That's one way to get your money out before 59 and a half. Not that we want that, right? It's a little bit better than death, but not by much.
Thanks, Carl. It looks like questions have stalled out for the moment. If anybody has any more questions for Carl, please type them in the chat. Use the Q&A function. While we still have everybody around, we do have we look like we're winding down, but Carl, do you have anything to say while we're waiting?
Nope, I just want everybody to understand that the Q&A session, October 16th at 6:30 p.m. Send your questions in to engage at Camaplan. We'll get them on the agenda and we'll get them answered. And I don't care if it's just covering the subject matter we covered in the last 4 sessions or general questions that you have. And if you want to do a personal consult, call the office at that number or go to our website. And obviously, if you're a NAREA member, you get a half hour with us, with one of the founders at Camaplan for free.
Perfect.
Here's some more of the numbers there, etc. I do hope everybody enjoyed these workshops and webinars. And I hope even more that you learned on ways to better your financial plan and pay less taxes, if that helps you.
Thanks, Carl. We have another question that just came in, and we do have Tim also thanks you again, and so does Cynthia and Catherine. Pamela's question comes in, is there a way to convert while invested in notes, etc.?
Absolutely, that's the way to convert. I mean, when you convert money, there's no question how much you're converting. If you convert, as an example, a piece of property, you can go out and get, an appraiser to give you that appraisal, but I've seen appraisals be off, easily 15% and sometimes 25%. If you've got a note and it's a long-term note, there are ways to do that, because there's people out there that, it's not just the unpaid balance, it's what could you get for that note. And the fact that it's tied up for 1, 2, 5, 10, 20 years is going to change the value of that note. And obviously what interest rate it is. If you did that note, back a couple of years ago, when the at 5%, when the savings bonds and CDs were at 1% or less, that note is going to definitely be a lower value than one that was done last year with an 8 or 10% interest rate. So yes, there's ways to value that book. Keep It will explain that to you. And I always say, look at your asset class and see what a reasonable value of what that asset would be.
Great question. Thank you, Pamela and Carl. Another question comes in from Sandra. She asks, is the $18,000 gift tax free to the recipient?
Yes, that's who it's free to. The donor is paying it, out of their tax bracket.
Awesome.
But all the 18,000 means is it doesn't come against your estate 13.5 million. You're allowed to give 18,000, this year to as many people as you want, without it affecting your lifetime $13.5 million.
All right. Thank you, Sandra. Thank you, Carl. It looks like that may be all the questions we have, and it's almost perfect timing.
Yeah, I did that on purpose. No, not really. The last one did run over, but I think people wanted the things answered. Again, let's go through the questions for next for next month, October 16th. Send them in to us or bring them with you. We'll be glad to help you.
And one more question before we wrap it up. It's just a follow-up, and this will be the last question. Sandra wants just to follow up and ask, is my Roth can gift the 18,000?
Your Roth, you can take a distribution from your Roth and then give that 18,000 to whoever you want. Your Roth isn't going to gift it. You're going to take a distribution from it, but it's not going to be taxable to you. And now you're going to give it to somebody.
Perfect. Thank you.
If you have any questions, talk to your, why I should, I'm saying if you're 59.5, it's not going to be taxable. If you're younger than 59.5, you may incur a penalty depending on how that 18,000 got into your Roth. And if you have any questions on that, feel free to call us tomorrow and we'll get right down to the nitty-gritty on that. If you made 18,000 in contributions over the years, yes, you can take that out, pay no tax on it, and give it to whoever you want. And if you're looking for somebody to give it to, I'm available. I'm only kidding you.
I wouldn't mind a gift.
Let's not be beggars now.
All right. Thank you, Carl.
All righty. I appreciate everybody being on here. This will be recorded and it will be up tomorrow. Don't hold me to that, but I think it'll be up tomorrow. If not, call the office and they'll mail you a copy or tell you when it's gonna be posted. Again, thank you guys very much. I look forward to seeing you at the next session.
Thanks, everyone. I hope to get to speak to you on the phone or in person someday.
So, all right, appreciate it. See everybody. You're welcome to everybody that thanked me.